Central banks eased, while asset prices screamed higher. That's a contradiction. The bubble's final phase has a pattern. It ends on funding math, not vibes. In 2000, momentum held until March. Then the Nasdaq cracked. In 2007, credit spreads stayed calm in May. By August, funding seized. Today's setup rhymes with both. Follow the money, find the pressure. The mechanism works like this. Cheap debt issued in 2020 to 2022 rolls at higher coupons, the fixed interest rates on bonds, through 2026. Interest costs rise, cash flows thin. That's when balance sheets show strain. The signal appeared this spring. Real yields, the interest rate minus inflation, stayed high while equities made records. That pairing does not last forever. When the price of time rises, risk assets pay attention. So far, the system shows a late cycle contradiction. Coming up, why liquidity stretches rallies before it snaps. Watch the timing. Markets can rise into the final phase. The last leg is usually the steepest. In 1999, the Nasdaq added almost half of its total 2-year gain in the final 4 months. In 2006, house prices posted their fastest prints just before inventories ballooned. Late phases look strongest at the top. The numbers prove the pressure path. Interest costs crossed $1 trillion on a trailing basis this year. That exceeds defense near $900 billion. The fiscal deficit, when government spends more than it collects, kept supply high. More bonds mean more funding needed. Check this contradiction. Headline inflation cooled from the spike, yet core services stayed sticky. Real yields remained positive. Equities still priced easy money. That split cannot hold forever. So far, late-phase rallies feed on abundant liquidity. Coming up, where liquidity comes from and how it fades. Follow the money. Liquidity is policy plus balance sheets.
Monetary policy, how central banks manage rates and money supply, sets the cost of leverage. Balance sheet runoff, when the Fed lets bonds mature without replacing them, drains reserves. Meanwhile, foreign exchange reserves, dollars and other currencies held by central banks, move with capital flows. When those three align, rallies breathe.
When they diverge, rallies wheeze. The pattern emerged across cycles. In 1998, easing after the long-term capital shock extended the tech boom. In 2020, emergency cuts and asset purchases extended risk runs. Each time, the last leg depended on cheap time and ample cash. Look at what happened after the tailwinds faded. In 2000, policy tightened into rich valuations. In 2007, funding costs rose while mortgage credit quality fell. The final phase ended not on announcements. It ended at settlement windows. So far, the plumbing sets the ceiling. Coming up, the three forces that decide when the break appears. Three forces collide in every bubble's final phase. First, narrative momentum. Second, liquidity. Third, price momentum itself. When all three align, returns go parabolic. When one falters, the air pocket forms. The mechanism works like this. Narrative momentum brings in late buyers. Price momentum, measured by moving averages, stays one-sided. Liquidity enables large issuance to clear. As soon as narrative slows or issuance strains, price momentum stumbles. That stumble invites de-risking. De-risking tightens liquidity. The loop reverses. Notice the gap. Corporate earnings forecasts can sprint ahead of delivery in late phases. That leaves little room for misses. It also concentrates flows in a few winners. Crowding, one-sided flow into the same names, raises drawdown speed. So far, momentum needs all three legs. Coming up, the players carrying the risk into the window. Follow the money, find the pressure. Primary dealers, the banks required to bid at Treasury auctions, warehouse duration when end demand hesitates. That inventory rises into refunding months. Auction tail, when demand is weak at a Treasury auction, shows up when clearing rates must rise to pull buyers. Term premium, the extra yield investors demand for holding long bonds, creeps higher when duration risk scares balance sheets. The constraint is simple. A maturity wall, when lots of debt comes due at once, arrives from late 2025 through 2027 for both public and private issuers. Rollover. Refinancing old debt with new debt resets coupons upward. Every 100 billion rolled 2 points higher adds 2 billion in annual interest. The math compounds. Watch the timing on auctions. When bid-to-cover ratios slip and tails widen, prices adjust fast. Dealers can only hold so much. Balance sheets have limits. That's when things shift. So far, the dealer channel buffers shocks until it can't. Coming up, the dates that decide whether the buffer holds. Warning sign 1 in 60 seconds. Issuance clears only with wider tails. The calendar sets the stress points. 3 dates decide the next move. November 15th, 2025 for October CPI, December 4th for the quarterly refunding announcement, and December 11th for the Fed's policy decision. Each speaks to one leg: growth and inflation, supply and duration mix, and the price of time. The critical number? Real yields near 2% on the 10-year. Above that, valuation support thins. The tell. Credit spreads, the gap between two interest rates, stay calm while issuance rises. Calm spreads mask slower absorption. The result? Small shocks travel farther. So far, the calendar concentrates risk into windows. Coming up, history's map for late phases and what breaks first. History shows a pattern. In 1929, margin debt soared while industrial production stalled. In 2000, profitless tech issuance stayed hot while earnings breadth narrowed. In 2007, structured credit volumes held up even as housing turnover dropped. Small cracks, big breaks. Check the timing. The peak often comes months after the most obvious excess. In 2000, March marked price. In 2001, earnings resets sealed it. In 2008, September was the snap. The early signal showed up earlier each time. The signal showed up early. Now the pressure builds. Today's narrative rests on productivity booms, lower rates ahead, and cost cuts from new tools. The risk is not the tools. The risk is the price paid before delivery. Expectations outrun time. So far, parallels warn that the top can look calm. Coming up, the exact triggers that flip momentum from one-sided to two-sided. The mechanism is visible on screens. Price momentum runs when the index holds above rising 20, 50, and 200-day averages. The break begins when price closes below. Rallies fail at those lines, and breadth thins. Breadth, the number of stocks rising, shrinks before indexes roll. That is how air pockets form. The math shows how small slips scale. A 2% daily drop after a crowded run forces risk control rules. VAR, value at risk, a position size limit tied to volatility, cuts exposure when volatility jumps. That selling hits the same crowded names. Liquidity thins intraday. The feedback loop starts. Watch what happens next. Margin calls follow volatility spikes with a lag. Derivative hedges add fuel. Dealers, short gamma, exposed to price swings, sell more into down moves. The move overshoots. Then rebounds fail at former support. That's classic late phase behavior. So far, price structure tells the truth faster than headlines. Coming up, how policy can slow the fall and why it cannot erase the math. Policy can stretch cycles. It rarely cancels arithmetic. Rate cuts lower the price of time. Balance sheet actions change reserve levels. Guidance shapes expectations. But rollover math does not care. Coupons reset higher. Interest costs eat cash flow. Issuers adjust spending. That slows activity. The numbers prove the constraint. If interest costs rise by 200 billion next year, that is money not going to capex, spending on big projects, or wages. If the deficit stays near 6% of GDP, issuance remains heavy. That keeps the supply pressure in place. Notice the contradiction. Soft landing hopes sit beside maturity walls. Earnings upgrades sit beside higher discount rates. Calm credit spreads sit beside heavier issuance. Those pairs break apart in late phases. So far, policy can smooth the path, not change the slope. Coming up, who benefits if the final phase stretches and who hurts if it snaps? The players divide into three groups. First, cash-rich buyers with long horizons. Second, levered players reliant on cheap funding. Third, issuers who must roll regardless of price. The first group waits and scales in. The second and third must move on the calendar. That calendar chooses the winner. Follow the money, find the pressure. Sovereign wealth funds, government investment pools, prefer steady entries. Pension funds match liabilities. Hedge funds manage daily marks. Each reacts to the same prices with different clocks. Late phases reward patient clocks until they do not. The pattern showed up early this year. Crowding raised correlation. Correlation, when assets move together, climbed as flows narrowed to a few themes. Narrow leadership makes pullbacks sharper. That is a mechanical outcome of flows, not a moral story. So far, positioning, clocks, and flows set the path. Coming up, the three warning signs that say mania is fading into exit. Warning sign 2 in 2 minutes. Breadth fails on new highs. If the December 11th meeting delivers a smaller cut, the snap you saw this month won't be the last. If CPI on November 15th prints higher on services, duration stays heavy. If refunding on December 4th tilts long and tails widen, dealers' buffers shrink. Calm on screens can change in a day. 3 things to watch that separate soft insulation from hard stop. 1. Breadth. If fewer names drive gains, momentum weakens. 2. Tails. If auctions clear weak, term premium rises. 3. Real yields. If they grind higher, valuations compress. So far, we have the framework. Coming up, a short map you can use to track the risk window. Numbers only. The numbers prove the map. Breadth above 50% keeps trend health. Under 40% for weeks warns of fatigue. Average auction tails below 1 basis point mean demand is firm. Above 2 basis points warn of strain. Real yields near 2% weigh on long-duration assets. Below 1% eases the load. Look at what happened when these aligned before. In 2000, breadth slipped under 40% by February. In 2007, tails widened as mortgage credit frayed. In 2022, real yields jumped as policy shifted. Each alignment preceded the turn. That's the setup. The final phase runs on faith in time and cash. When either costs more, the faith fades. Late stages feel strongest a step before the slip. So far, signals, mechanisms, players, and calendar are on the table. Coming up, the dashboard and the closing scorecard. Facts only. 3-line dashboard. Breadth. Above half, trend alive. Under 40, fatigue. Auction tails. Under 1, firm. Above 2, strain. Real 10-year. Near 2, heavy. Near 1, relief. Auctions. Firm or soft. Real yields. Rising or falling. Central bank flows. Adding or pausing. Small cracks, big breaks.